All right, folks, welcome back. Today is Tuesday, August 8th, 2023, and it's time for another video on financial, economy, and all that. Cheers. So what am I actually drinking here? Well, this is one of my favorite pastimes. This is Scotch whiskey. This happens to be Bruichladdich Port Charlotte Islay Barley from 2012, and it's just delicious. But that's not the purpose of this video. So the reason for making this video is that I recently posted about my asset allocation and why I selected the mix that I did. And as a follow-on to that video, I received a comment from a viewer that basically says, Warren Buffett says that long-term treasuries are a horrible investment, and have I looked into shorter-term treasury?
One thing we know is we think that long-term bonds are a terrible investment, and we, at current rates or anything close to current rates.
And I did respond, but I wanted to make a video to kind of go into this in more detail because I think it's a very important concept. So let's jump right into it and see what I'm talking about. In terms of stock market investing, right? You know that if you're leaving your money just under the mattress or in a regular checking account, you're not getting much because interest rates have been very, very low for the much recent past. It's only been this year that's gone up to where you're getting some decent rates. But in the past, if you just put your money under the mattress or in a checking account, you're not going to come out ahead. The only way to do so and beat inflation is to invest in the market. But the market has a lot of volatilities. And I want to kind of demonstrate that by going back to my favorite tool again, Portfolio Visualizer, and taking a look at what happens if you put 100% of your money into the stock market. So here for the asset class, and I'm using specific asset classes rather than using specific investments because I think this gives you more data to look at. But let's go ahead and analyze a portfolio. It'll go back to January 1978, so it's quite a long time. We're talking 45 years here. And see what happens if you put 100% of your money into the stock market. So by default, I didn't really change any of this. It's basically saying, an initial investment of $10,000. That's pretty common. But let's see what happens when we analyze this portfolio. Well, when we do that, we see that between 1972 and 2023, you would have had a 10.50 compounded annual growth rate, which is pretty good. And if you kept it all that time, your 10,000 would grow to 1.7 million. Now, this is a much longer time period than 1978 to 2023. In fact, this is about a 51-year period that we're looking at. So let's shorten this time frame so we can compare it when we add in other asset classes. So I'm going to manually force this to 1978. Reanalyze. And you see that the compounded annual growth rate jumped up to 11.6% from 10.5. This is because we skipped some of the early years of the 70s where things weren't doing as well. But this is a good point for comparison. This is pretty good for 45 years, right? But the challenge with 100% stocks is that there's a lot of ups and downs. And when you look at the standard deviation, you'll see that it's quite high. And what's worse is this metric right here, the maximum drawdown, almost 51%. And I think I talked about this in my asset mix video. But this is really important. Even if you're not using the funds to live off of, max drawdowns can be quite discouraging and can force you to withdraw from the market and not invest. So for me, this is super important. When we begin to look at annual returns, actually, I'll go back to summary. We can scroll down and look at the annual returns. You can see that it's very variable, right? So it's a bumpy ride, but you get quite a nice return. So for me, the reason that I use long-term treasuries is that I basically have a 60-40 portfolio. Because if you think about what my allocation is, it's 50% large cap growth, 10% REIT, and I'm using Realty Income Core. which is essentially almost like an equity. It is a REIT, but it's also an equity by itself. So you add the two together, it's 60%. If I do 60-40 with long-term treasuries, and I'll do the same, but this time I'm going to put it in, I'm putting in short-term treasuries, just so we can see the difference. Okay. And I'm going to move the 60 from total stock market to large cap growth, which is closer to what I had allocated. Let's take a look and see what happens. And you know what? In fact, I'm going to do stock market versus large cap growth, but in the same proportion, just so you can see why I moved it to large cap growth. So when you do this, what you'll notice is that, yes, your compounded annual growth rate goes down a little bit. And if I had used the total stock market instead of large cap growth, it goes down even more. But the key here is that your max drawdown is significantly lower. Okay? So there's this trade-off, and the question is, do we accept the slightly lower return for a less bumpy ride? And if you go with short-term treasury, the max drawdown is even lower. This is important because if you think about what's going on here, when you are in short-term treasury, it's going to be less volatile. It's going to have less drawdowns, and it's shown in the numbers. But you also have less returns. So that's the trade-off. So what's the bottom line here, and what's my message? My message is that, yes, I've looked at it, and if you were to look at just long-term treasuries on its own, and in fact, we can just put in 100% long-term treasury as an investment, it's terrible. Just like Warren said. I mean, it's not terrible in the sense that it's going to give you a negative return, but it's worse than stocks or some combination of stocks and whatnot. And the drawdowns on just 100% long-term treasuries is pretty bad as well. This is a case where the sum of the components are greater than its individual parts. And that's really the message that I'm trying to drive home. You should not evaluate a portfolio by looking at its individual assets in isolation. That's a mistake. The concept is to evaluate the whole portfolio as a portfolio, the entire thing as a thing, right? You can think of it in terms of baking a cake. I can tell you that, if you eat salt and just salt, it's going to be terrible for your health. And that's true. But if you eat salt and it's a pinch in a cake or a dessert, it actually enhances the flavor. And you can't just tease apart the salt or the eggs or the baking soda or the flour or the butter or whatever and say that thing on its own is worse than the cake, right? You have to look at the cake as a whole. And that's how you should view an asset allocation. It's not the parts in isolation, because I've heard people complain about, well, I don't want to invest in gold. I don't believe in it. I don't want to invest in whatever. You take your pick for whatever the asset allocation is. If you do that, you're going to miss out. You're going to miss out that the sum of the components are greater than its parts. And that's the key message that you have to realize. And maybe you have to hold your nose and say, you know what, I don't like long-term treasuries, but in the portfolio, it does what it's supposed to. I had to do that for gold because I was not a gold bug, but it's proven itself over the course of over 100 years that it improves returns when it's a part of the portfolio. So that's the main concept. The other one that I want to draw your attention to, and it's less minor, so you can stop kind of looking, at watching the video, although I do hope you watch it all the way through, is that there's this concept about asset correlation, right? And it's the zigging and zagging of things. So when your investments in one category are down, you're hoping that you have another asset that's either going up or at least flat to kind of provide a buffer so that your whole portfolio doesn't take a big tumble. And that's the whole idea with asset diversification and the correlation of assets, because you really don't want to have things that are moving all together. So when one of your investment is zigging, you want the other one to zag. All right, so we go to the Assets tab from the evaluation and scroll down so we see the monthly correlation, this section right here. You can see that for the stock market, it has a 1-to-1 correlation with itself, which makes sense, right? It's an identity. But large cap growth is also very highly correlated with the stock market, although it's not exact. But then when you compare large cap growth to long-term treasury, this correlation is approaching zero, which means that they're almost uncorrelated. And you want things that are uncorrelated or even negatively correlated when you're building a portfolio, because that's how you're going to reduce risk. But like I said, this concept is a little bit more advanced to think about, but it's basically saying that when one of your assets is zigging, you want the other ones to zag. So they have to work together. You cannot tease them apart and try to evaluate them based on their parts. As a bonus, I'm going to share something else that Buffett said, which runs counter to what a lot of people think, which is that he says diversification is a terrible thing, the way that it's practiced normally, because it just shows that you don't know what the businesses you own are doing. And this is a quote from him. So here's a video.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
But what's clear is that we do not have Buffett's skills, right? This is why, a lot of the advice that you hear, even from gurus out on the internet, Buffett he knows what he's talking about. You can't just take, these advice at face value. It's best to learn from them and really try to understand what is being said. Because when Buffett is saying, diversification is for fools, what he's really saying is that if you take the time to evaluate businesses, you really understand them, and you see that this business is better than the other, of course you're going to own the other the best business, and not the one that's not as well. That just makes common sense. The problem is we don't have his skills, right? We just don't. Most of us don't. We're not Buffett. That's clear. So you got to be careful when you're listening to some of this, because some of the advice will run counter to what makes sense for most people. Because diversification is the best tool and the best free lunch most of us can get that's out there, right? Because we are not Buffett. If we are, we would be picking individual companies. And he's absolutely right. But be careful when you're listening to gurus on the internet or anybody, including me, because that's a logical fallacy that's called appeal to authority. And you shouldn't do that. You should really try to understand what's going on. Anyways, I'll get off my soapbox. Thanks for watching, and I'll see you on the next one. Bye.